access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacity as licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar website or promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read the characteristics and risks of standardized options. PSW provides education and training services that are meant to teach the risks and potential rewards of trading options. And we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. Fantastic. How is everyone doing? If you're reading right now, we cannot hear you. You smell nice, too. What? What on earth is that? All right. We'll leave Jim's comment to now, let's see. What do I want to talk about? Well, let's see. First of all, first of all, there's an opportunity right now, so let's take it. The indexes are moving up, and the Nikkei is lagging. The dollar is firming up at 95.50, so let's take a shot and go long on the Nikkei. So what do I see here? I see a big bounce on all the indexes, but not the Nikkei. So it's lagging everybody else. I see the Nikkei is paused just below the 16,850 line, and the dollar here is stuck at 95.50. So if the dollar fails 95.50, we get out of the trade. If the other indexes start failing, we get out of the trade, especially if 1160 on the Russell doesn't get taken back. But meanwhile, we have a nice chance to have a quick 50-point profit on the Nikkei. So we're going to go, oh, there's the Nikkei, how convenient. So we'll take a long here. Let's see if we can get filled at 16,840. Yep, there it is. There's my order. Not looking too good. So while I'm filling, I'm watching this. He's 29. He's going down. 27 and 7, 29 and 7, 24 and 9. That's not good. That means there's more of these. 28 and 9. See, I want it to push down a little bit, so I want to see this number getting smaller and this number getting bigger. If I want it to go up, 19 and 8. See what's happening? So I'm going to lose it. So I'm going to buy my position here now. Okay, so I took the 45 because this is heading in the wrong direction for me. The pressure is moving this way, 19 and 8. Now it went the other way, 17 and 31. I still have my one order at 16,840, but I don't think it's going to fill. I think we're going to go up before it goes down. 8 and 29, so we'll take a look and see if I'm right. Did I jump the gun or... So in other words, what I'm watching is obviously if there's more open orders here and less here, that means they're running out here and they're gonna push up. And I do see it feels that way to me. You get used to watching them. This 50 is steady and this 50 is steady. There's plenty of big numbers here. There's plenty of big numbers here. So this is a real point of contention. You can see that because you're forming up a resistance line here. So at this resistance line, there is a tremendous amount of contention on both sides. See what's happening here? Now it's 19 and 9. See how that's changing? That's what you're going to see right before it jumps. 22 and 9, 17 and 12. Look, now they're evening back out. 18 and 12, 19 and 12. But remember when we started, it was 30 and something, 30 and 10. So it's changing drastically, and that means the weighting is heading up, 22 and 2. I think I was right. Notice it still hasn't filled. My order here at 40 never filled. 24 and 2. See, when he runs out, then it goes to the next one, the whole thing will jump up. Oh, there you go. See, now it's 1 and 35, and the cycle starts again. It's nice because it doesn't always move so slowly, so you don't always catch it. Oh, and I see, now we're firmly back over, and now there's no way to get my fill at 40. So that's why I clicked on that, because I saw that. I could see the pressure was moving in that direction, and I did want to get at least one under the gun. Oh, now 45. See, now look. Now we're firmly at 45, and now we're working on 50. But that's what you want to see. Now that we're in it, that's exactly what we want to see. But meanwhile, we're concerned about the dollar, because the dollar failed 95.50, and that was our premise, that the dollar was going to stay strong. So if the dollar keeps falling, I don't want to be in this Nikkei long trade, unfortunately, so I might have to take a quick out. But the S&P still, the Dow's still going up. This is natural gas. We're not going to bother with that. So we'll go to ES over here, the S&P. But, the S&P is still up. This is still up. It's only a little dollar fluctuation. So I think I'm going to let it slide for the moment, since we are going in the correct direction. But my main premise was that the dollar would still move up and catch up to the indexes a little bit. That's not happening. All right, but it's possible the dollar is just being sort of manipulated lower. See what happened? Because the dollar fell, it pushes down now. So now I could have gotten my 40 pill if I was more patient. So now 45, and if 45 goes easily, then we're going to see 40, and I'm not going to be happy about that. But then this should hold. You see this nice consolidation here? That should hold right about the 40 line. And I wouldn't mind adding one, because I still like my long premise on the Nikkei as long as these guys don't start falling. So let's think of how weak this gets. Now I'm going to hear a loss. I might end up back at 16.8. And if I get another one at 16.8, I'm going to average like 25. All right, so we'll come back to that in a few minutes. That did not go the way I wanted to. I wasn't patient enough. The dollar did get rejected here, and I could have stopped out. I had plenty of opportunities to stop out and get out of the trade, which, if you don't want to lose any money, that's what you do. But I'm willing to add and see what happens. And mostly because the falling dollar is not going to make the indexes, it's not going to make the U.S. indexes go down. It's only going to make the Nikkei go down. So if the U.S. indexes is still strong, then the Nikkei is still way, way behind. And it still hopefully can catch up. And we'll see how much damage it actually takes. So for now, one contract, we're not going to be killed by it, so we'll watch what happens. Latest Brexit polls say staying is not a slam dunk. Last I heard, it went the other way. It went the leaving was a little bit ahead. In your opinion, will the dollar zoom along with gold? Yeah, I mean, look, there's only so many dollars you can really buy with all your euros, right? I mean, we're not talking about a little move. We're talking about the second biggest currency in the world. People are going to be leaving it in large quantities, and they've got to move it to either dollars or yen or gold or silver or, Swiss francs or whatever. But conceptually, money, there's going to be a lot of pressure on a lot of things where people want to get their money out of frickin' Europe. So, the more unsure people are, the more it's going to go. So it's going to be one of those very rare situations where you probably see the dollar go up and gold will go up at the same time. Did you turn audio options and listen only? I didn't even know there were such things. Okay. All right, how's our little futures trade doing? Let's see if we make any progress here. Yeah, it's hanging in there. Like I said, here's the dollar. It's kind of bouncy over here, so we'll see what happens. All right, anyway, since it's a nice quiet day, not much is happening, let's take a look at our portfolios a little bit more carefully than we usually do. Let's talk about our overall concepts of positions for the moment. So we'll start with our tiniest portfolio, our 5% portfolio. This is the options opportunity portfolio, by the way. All right. At the moment, we're up 53.6%, which is very nice. We're well ahead of our schedule. That's from August of 2015. So we've had, this is June, right? So June, July, August, 10 months. So in 10 months, 53%. We're supposed to be up 50%. That's why it's called the 5%. That's why originally it was called the 5% portfolio, because we want to make 5% a month. And when I set it up over at Seeking Alpha, I told them we want to set up a portfolio like that. They decided that they wanted to call it the Options Opportunity Portfolio because they felt that calling it the 5% portfolio would not be explanatory of what we do. I'm like, well, what we do is we make 5% a month. I'm like, isn't that, do people really care how you make 5% a month? I find that the very funny thing about options, because people look at the returns on some of these portfolios, and they go, oh, well, you're using options, as if that doesn't count. And they're like, I don't use options. And it's like, okay, so maybe you should think about learning to use options instead of saying, I don't use options, therefore that doesn't apply to me. I mean, it's a weird thing. I mean, when something works, it's worth doing. It's worth learning how it works. So what do we have here? We have SJB, and that's the anti-junk thing. That's not doing so well right now, but it's got plenty of time. We have ABX, and that's short puts on ABX. I'm very confident in those coming in the money. These are short puts. We have FCX, also very confident. Target, that's a new one, and I'm happy with that position. I mean, look, we sold the $60 puts. They're at 68, so it's practically 15% in the money. That's a hell of a deal. We still get, and then we get another $5 off, so we get another 10% off. So it's like a 25% discount to the current price of Target, because we would net in for $55. So I love that position. That's a great position, brand new, so obviously playable. USO, that's also just waiting for it to expire. I mean, why would I pay them 2 cents? There's no way USO is going to be below 8.50 in July. So there's no reason that, even, 98.2%, we can close it out for $20, but we don't need the margin, and it's just going to die on its own in, like 30 days or something, right? Then we have Williams-Sonoma. We have a lot of these. They're back to evenish. Again, now, this one's actually different. This is much more aggressive. We sold the $60 puts for January. They're at 53, or just under. And so it's $7 in the money right now. So this price, of course, is more than, that's the premium, it's $3. The amount over 7 is the premium. And I'm comfortable with that. I'm comfortable with the target. And look, you also have to be comfortable with saying, well, what happens if it doesn't work out? Williams-Sonoma. So we have the $60 puts. So we go onto this thing and we take a look at what's going to happen to it if we have to roll it. It's only 6 months away now. So realistically, there is a pretty good chance that we'll end up rolling it. Oh, I see. There are no 2018s. Ah, my bad. All right. So we sold the $60 puts. They're right about $10. $10.20 was the last sale. And shoot, what else is $60? DHS. How about DHS? They must be 60. Okay, 64. Close enough. Oh, they don't have any things. Damn it. I'm trying to think of a $60 stock. BTR? How about BTR? VTR. There we go. Okay. So, nope. What's Netflix is 90. HEO? Ah! Please have 2018. Okay, there you go. Fantastic. No, I'm wrong. Why did I think they were 50? Texas! Oh, that's a good one. TXN. Ah, thank you. There we go. Okay. So the Texas Instrument $60 puts of $4. Wow. Seriously? Now, see, this is why I like the Williams-Sonoma puts. The Texas Instrument, well, they're not a 50, though. That's why. Damn it. That's my problem. I shouldn't have even been looking for $60 stock. I should have thought of that. All right, well, it doesn't matter. Okay, let's use the 70 puts then. So let's assume that if we go to Texas Instruments, the point is $10 out of the money. So Texas Instrument, $10 out of the money at 61. So let's say we have the 70 puts, they're about the same price, so $10, $11, right? So the question is, where do we roll in 2018? And if you look like here, at just about $9, so for $1, you roll down to 62.50. So for $1, we can roll $7.50 lower. Okay, based on Texas Instruments pricing. So figure for $1, we can roll down, $6, $7. So there's the thing. So when I'm looking at this position, and I wonder if I'm worried about it, my assumption is that I can roll this for $1 to the 250 puts, or at least, certainly the 55 puts, but probably the 5250 puts in 2018. So it's at 5250. So I can actually roll it to be on the money when the 2018s come out. So why would I worry about the position? See, that's what I mean when I talk about looking at the move ahead and thinking ahead of what you can do next. That's the way to look at it, is think about what you can do with the position. Even if it's not visible now, you can take examples from other options that are similar price and figure out what you're going to do about it. All right, SDS, is this a new one? No, this is the old SDS. The September 16/22 bull call spread. Okay, that's in the money by $2. Oh, damn it. All right, that phone, I can't ever get that phone to stay on. Hopefully it'll pick up soon. The SQ2 is another hedge. They're out of the money, and this one's going to expire. I thought oh no, it wasn't worth recovering. It's just dead. All right, so this is just a dead trade. Now, how much did we spend on that trade? We spent $1,400. So that was the cost of that insurance, and it died. We didn't really spend $1,400 though, because we offset it with the short calls of some sort. But anyway, so that's beside the point. UNG is our natural gas play. We had a short-term one on the July 7-8. Now, we only spent 17 cents. We only spent 17 cents on that trade. All right, so we're now in the money by 15 cents. So we're looking okay, and we have another month. So what we need to do is recover 17 cents, and we'll be even. TLT. We took the short here. It's still not going down as fast as we thought it would, but we spent $4 on the spread, and it's $5 in the money, so we're not too worried about that one. USO, this one was a July target. We bought USO for $10.50. We sold the puts and calls for $1.65, so whatever that works out to, $9.85, I guess. So anything over $9.85 is a profit, and all we can make a profit up to is 11, though, and they're well in the money at $11.83, so that one's going to be fine. Apple, we're fine. We added 5. We sold half against the long calls. We sold half the July 97.50 calls. They're at just under 100 now, and we just want to get a little bit of money just in case it goes down. We want the money that we can then apply to rolling later. BHI was a long haul play. We're going to just sit on that and see what happens. But it's really in good shape. I mean, we sold the January 60 calls, so we want those. We don't want it to be higher than 60 in January. We have the long 40-50 spread, so we want it to be higher than 50 but lower than 60, and we're going to be fine. That's not complicated. BID is now super duper in the money after all the trials and tribulations on these guys that we were worried about. In fact, they're so in the money that we now have a problem with our short July calls, but it's not really a big problem because we only sold 15 against our 40 long. All right, so that'll be fine. Disney, we have a 92.50, 97.50 bull call spread, and we're above that already. We have the short June calls, the long October calls, so we're going to roll these short calls when they come to expire. and then we'll see what happens. We'll sell more calls and make more money. But otherwise, we're right on target. GoGo. What happened to them? I thought they were on track. Well, they are on track. I mean, we bought the 8s, we sold the 13s, and it's at 11, so I wouldn't say it's off track. And we sold the $10 puts. Let me take a look. Oh, I did it again. I always do this. I always forget to get these, my favorite little FinViz charts. I always forget to put them up. Nope, can't do it with that one. There you go. GoGo. Ah, yes, see, they were making better progress, but they fell back a bit. But I'm good with these guys. I think they're on a nice track. Hovnadian, very slow moving. Let's see how they look on the chart. So they're making progress. They have this nice little rising sort of thing a little bit, but, you know, real slow and squeaking it out. But, you know, again, I like them. It's a very long-term play. Oh, it's not. I'm sorry. Ha, ha, ha. It's a January play, so we really have to invest. We have fortunately, the 150 calls. We sold the 250 calls, but only a half sale. We're kind of right on target, though. I guess this is going to be fine. And then when these expire, we'll sell some 2018s and turn it into a spread. IMAX, I thought they'd be doing a little bit better by now, but we're still in good shape on these. You know, it's a $3,000 profit. I had thought that the movies that are out now would be doing better, but we did have a poor weekend. You know, this weekend, the Memorial Day was not that exciting. So they've been on a nice build. I'd like to see them up at about 35, 36 before we sell. Okay, so we have until January, but of course I expect the summer. So maybe in July it'll peak out, and we'll probably take the money and run by then. Leibu is a split thing that we're stuck with until it expires. Lumber Liquidators is look, as long as we're over our put, we're happy, right? Because that means this will expire worthless, and we'll pick up $2,500 there. This is in the money, so we're in good shape there. And all we need to do is see a little bit of progress as they have the next 2 earnings reports. Marvel, or Marvell, I guess. These guys are totally on track. $10 is our target. SQQ, we don't want that to be on track. That's a hedge. But they're at 17. They're right at the bottom of our range. This is a new one we added last week. Taser is way blown out of the range, so we're just waiting for that to move ahead and expire. Do we sell short calls? No, we're in good shape. Twitter, still a disaster, but you know, look, it's a disaster, but it's $5 in the money for us. It's up a few $100. And when these guys, well, this is a year and a half from now, when these guys expire worthless with 13 puts, we pick up $2,700 just on the put side. So I freaking love these kind of positions. I'm telling you, it's like that's why all these positions have turned into those be the house kind of things, where we're, you know, it's getting more like the butterfly portfolio. Now that we have our money, because when we started, we only had $100,000. We didn't have a lot of room to mess around. As we got more money, we were able to take some more aggressive positions, and now, in fact, and frankly, also this portfolio did get off to a bad start. We got hammered. Our timing was awful last August, and the market crashed right when we started taking positions, so it took us like a month or two to turn it back around. But once we had a little bit of money, we were able to take some more aggressive long-term positions instead of trying to, you know, just getting 5% a month is hard when you're just starting out. So we were trying to keep getting 5% a month. That was tricky. Now it's easy because now it's just boom. We have all these long-term positions we sell calls against. It's no problem. TZA, another hedge, okay, and that's actually right on the money also. So we're in great shape. If the market starts falling, we're fine. Here's UCO. That's ultra. that's so totally in the money. It's not worth discussing. That's UCO, and that's going to expire in the money. And here's UNG, another one, a longer-term UNG. And that one's not quite on track because we aggressively sold the $10 puts. But look, we're actually, even though we were super aggressive, look, we're only down like $400 on this position right now. And I still have, of course, total faith in that position. It's our trade of the year. So I like it. It's just been very slow getting off the gun. Oh, what happened to my Nikkei? Look. TikTok. Ooh. I didn't miss anything. It just isn't going anywhere. Okay, so the dollar, though, fortunately, has bottomed out. The indexes are still in pretty good shape. So I'm not looking to change it, but I'm also not going to add it unless we get down to 16.8. All right. Cuestiones. Can we practice LTP? Well, we're going to look at the LTP, sure. All right. We sold July, blah, 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 puts in the butterfly portfolio. Now it is 9:23. Should we make any adjustment to it? What? Juan, what are we talking about? I have absolutely no idea what position you mean. Target. Okay, so no. No. Target is, look, Target took a dip, okay, and we sold what, 67.50 put? No, 77, wait. We sold 77.50 puts, okay. So we sold the 77.50 puts. It dropped down to 66. We didn't do anything. Came up to 70. We didn't do anything. Came down to 68. We didn't do anything. We have until July, so the next 30 days, hopefully it'll be between 70 and 72. And then when it's time, we'll roll them and we'll sell something else. That's all. It's not a big deal. It's like you have to just learn to be patient and let the things work out over time. There's no reason to rush unless something drastically happened that we don't think it's going to recover. It's going to recover eventually. We just don't know when. And Rob said, I entered late, can you repeat? The only futures trade we made, which is not going well so far, is the Nikkei. And we picked up a long, see, at 16,845. And it's down to 16,815. Now, my intention is to get another one. Now, since I'm not paying attention, I'll do this. So I just ordered one at 16.8. So if we get back to 16.8, it'll add one, and my average will be down around 16,820. Okay, or 22.50 to be exact. So the average of 16.8 and 16,845 is 16,822.50. So if this fills, the one order I just placed right now, see, buy Nikkei, blah, 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 16.8. So if that fills, I'll hear the bell at least, and we'll know we got to fill. And then hopefully that line will hold. It might not, though. It might go further below. But I'm just waiting and seeing how it goes. You know, the Nikkei is down from 17.2 to 16.8. So that's like, let's see, that's about 500 points, okay? So 500 points is quite a bit. Scientifically speaking, it's quite a bit. It's past, oh, here you go. Let's get the old calculator. Actually, no, here. Where's the, now I need my futures charts. All right. I'll show you why. Because we have the 5% rule, and within the 5% rule, which is the same thing as the 2.5% rule, right? So where did we top out? We topped out at 17.2 basically, or 17.1. Those are your two possible places that you could say there was a consolidation. Let's actually first look longer and see if there's anything more clear. And there's not really. Maybe 17.1. It's hard to tell what March and April are, but let's say 17.1 seems to be a thing, at least. So if we go 17.1, this is how you can apply the 5%. 17,100 times 0.975, 16,672. So right about 16.7, we expect some very serious support. Now, if instead, though, it was 17,200, and shorter term, since we're playing shorter term, we should look for the shorter term bounce. So if we call the bounce in 17.2, or in fact, even more accurately, let's actually use the spike to spike. So 17,250 times 0.975, so 16.8, which is why I wanted to go long here. So 16,820, roughly, is the minus 2.5% line from the top. All right, so how many points is that? So that's minus 17,250, 431, right? So a 20% overshoot of that. So 431 points, and again, then you got to start rounding up. So then you say, okay, let's go at 400 points. So 400 points from 17.2, from 17,250 would be 16,850, which is where I wanted to go long, right? So 16,850 would be the 2.5% line. And then 40 points below that, 80 points below that is 16,770. So now we go to the chart again, and we see a 16,770. That would be a 20% overshoot of that run. So if 16,770 held, and here it is, 16,770, okay, that means the 5% rule is completely working. So from the top, at what we're calling 7250, we like to round it off to round numbers. So it's at the top, and you can see the resistance line here anyway. So from here to here is 2.5%. And then the overshoot takes you down to here. One more line, basically, would take you down to here. That means we expect then a bounce to here is a weak bounce, and that's exactly what we got. And now the next bounce, if we get a next bounce, we expect to see a strong bounce that could take us all the way back up to about 950. So that's what we're looking for. We're looking for 950. But it's not looking good so far because we're getting resistance at the weak bounce line at 850. But because it keeps trying, it looks like it's probably consolidating for a move back up. And what we need is a dollar to do a little bit better than it's been doing. Now, interestingly, though, this is something that's not being picked up on. If OPEC gets the price of oil higher, the higher price of oil creates a larger demand for dollars because dollars are what you use to buy oil with. So actually, if OPEC is successful, the dollar should actually go up. So that'll be interesting. We'll see what happens. Meanwhile, though, I'm waiting to get my fill. I still have my order at 16.8. But my theory is that we should at least get back to 850. And what happens when we get back to 850? If I get my fill at 16.8, my average is 820, 822.50. And then once we get to 822.50, I stop out, and then I have one order in that's long as 822.50 for my average. All right, so then even if we fail at 850 again, I can get out there, and I made a little bit of money. All right, so that's basically the plan for that trade. We'll see what happens. Meanwhile, though, I'm not happy because my indexes are failing. He failed 750. He failed 95. So I'm not that happy with this trade right now. Silver's gone below 16. Where do you think would be a long entry? We really like silver at 15. That's our big entry point that we love. And but we take the 50. We take 16. Well, yeah, we take 16.50 if that's all we think we're going to get. It's been a long time since it's been that far. It's funny because for a long, long time we could never get it over, and now it hasn't been under. So I'm sorry, 15.50. Here it was. So back in the spring, we were playing the 15 line. So every time we got a crossover, which was a few times, we played it. Then we got this super duper run here, and then we lost interest. And once it went up past 17.50, we were like, oh, forget it. You know, we weren't interested. We didn't want to short it because we liked silver, but we didn't want to play it either. 16 is kind of tempting. If it holds 16, it could be forming a nice base at a new high. All right, or I'm sorry, a new high low. So for the lows, it's a new high. If we form a nice base at 16, that'll be good. But so far, obviously, 16 didn't hold up very well. 1550 though, I play for a technical bounce. 15, I play for a bounce. And if it gets to 1450, I start with conviction buying it, where I would buy it, and even if it went to 14, I would just buy more. Okay, that's a conviction play. Here, if I'm going to buy here, here, or here, I'm going to use tight stops. Because there's no real support below these guys. It's just a matter of these are all places where we could start seeing some kind of support, including 16. So over 16, I wouldn't mind playing it, but watch the dollar. Really can't play when the dollar's going up. Watch gold, because you want to get a confirmation from gold. So if gold's holding 1200, then expect silver to hold 16. That's all. And if silver doesn't, if they fail, then we're going to look for the support at an 1150. So it doesn't matter. It doesn't matter where silver is. Gold's going to have a more prominent support. So when gold gets to 1150, whatever silver's at, when gold's at 1150, is where you want to start playing silver long. But hopefully at one of those 050 lines on silver. All right, that was the, wait, did we get through the OOP? Were we done? Yeah, we were done, weren't we? Okay, good. Wow, that took a long time. All right. Butterflies. Wow, 166%. That is incredible. All right. So here we have, this is, in Walmart, we took the short calls and made them their own thing because the long spread got complicated. We have, this is what we call an artificial buy right. So instead of owning the stock, we own a bull call spread and short put. So we will own the stock if it gets cheap enough, but otherwise we only artificially own it between 75 and 62, between 65 and 72.50. So it's an artificial buy right. We bought the bull call spread, we wrote the short puts, and we established an artificial position on the 2018. We're at the top of the range, so mostly what we're doing with our positions, our short calls, is we're protecting ourselves. We're locking in these gains because we have a nice 750 times 30 is a lot of money. It's like $20-something thousand coming to us if this thing stays where it is. And you see this, it's only right now listing at 13,000, right? 27,000 minus 14, 15,000. So it's listing about 12,000 in fact. Whereas in fact, it is 750 times 30 is much bigger. 750 times 30, 22,500. So this $22,500 position that's almost entirely in the money is only currently booked at 13. So all Walmart has to do for me is stay up around here, and we're going to drop another $10,000 into the portfolio. That's good, right? I mean, that $10,000 is 10%. That's 2 months worth of income. Ah, that was the sound of the Nikkei filling. So now what do we do? So we hit 16.8. The dollar didn't get particularly weak. The indexes are not looking that great, but still, what's our primary job now? See how our average is now 2,250? So at 25, I'm going to put in a sell order. So if we do get a bounce, it'll put me back to 1 with a much lower basis. All right, and I do like the way that it spiked down. If you look at it, we'll look at it closely. See that? It spiked and came up quickly, so we'll see what happens. Oh, now it's drifting back down. And now I'm more closely watching the dollar than I am the other indexes. If the dollar goes up, I don't care. The Nikkei likes that, and we know that. So we'll see what happens there. All right. Where were we? Oh, yeah, Walmart, only the first one. Anyway, so a lot of money coming in. Not only that, though, but also this minus 2,000, of course. As long as Walmart is over 55, that 2,000 evaporates, too. So that was, what do we say this was, like 10,000? So we have $12,000 coming to us on the back end if Walmart is over 72.50. So that's how you plan out your trade. So that position right there pays for 2 months' worth of my gains. I need to make $5,000 a month in this portfolio. So if you need to make $5,000 a month and you have 12 positions, each position should be making you $5,000 at some point in the next year, right? That's how you get on track. If they're not, then you're not going to make your $5,000 a month, even if you're on track. So you better be, looking at all your positions that way and saying, what am I going to make out of this thing? Apple, we just sold half on the short calls. The July 97.50s, we sold them for $3.90. They're still $3.70. So, and probably if you're selling now, you can probably still get $3.90 because these prices are always, the worst of the bid and ask. In this case, we're long the 85. We're well in the money. We're at 99, so there's $15 in the money, so that's good. The short put, same story, right? They're currently marked 3,800 against us, but if Apple stays over 85, we'll make that $3,800. So expire worthless, and the short calls will be what they'll be. That's easy. Disney, is this butterflies? Yeah. It's so confusing because the butterfly portfolios, we talked about this yesterday in chat. The butterfly portfolios, they always start out as a certain kind of trade where we're buying long-term puts and calls, and then we're selling shorter-term puts and calls against them. That's how they mostly start out, but then if the stock changes, we change the position, and so they're no longer looking like a typical butterfly play. In this case, again, we've got the artificial buy, right? We're at the 80-110 bull call spread. That's nice and aggressive, which I'm glad because I'm aggressive on Disney myself. So we have the 80-110 bull call spread. So that's 30 times 20 is $60,000 on that bull call spread. The net, of course, on the spread was was $32,000 was the net price of the spread, but that was offset by the sale of the puts for $20,000. So now we only spend $12,000, and then we sell these calls for $3,000. And now we spend $9,000. So here we spend $9,000 on a potential $60,000 spread. And not only that, though, but if these guys expire worthless, we'll sell another set of calls and another set of calls. And if we can pick up $3,000 like 4 or 5 more times, that's another $10,000 drops in our pocket. So if this guy stays on track, he'll make $60,000 by January 2018. And all Disney has to do is go up $10 between now and 2018, and that's what we're going to get, $60,000 profit. Now that is enough to keep us on track for an entire year. So that would be very nice. GIS, okay, so these guys, we've got the, this is a proper butterfly. We own the long calls, we own the long puts. This is a proper normal butterfly setup. So, in other words, the calls are $7.50 above the puts. The puts are $5 below the puts that we sold. So we can't lose, even if it goes all the way, if it gets bought out for $1 million or if it falls to zero, we can't lose more than $7.50. That's the maximum spread we have between our positions. So our max loss is $7.50. Times 10 is $7,500. That's the most we can possibly lose for this position. And in fact, that's why the margin requirement here is actually fairly low. 94,000. We have 300,000 in buying power because we're 2 times our portfolio value, right? Which is, 266. We have 500,000 in buying power, and we're only using 100,000 in margin. That's crazy. So, so we use very little buying power, and the reason is though because we're protecting our spread. Everything's protected. This can't lose more than $7,500 this position, but meanwhile, what are we doing? We're taking a net $6,000 position, and in April, we sold June positions, so April, May, June. So we sold 60-day positions, and we collected $4,000 against the $7,000 outlay. So we collected $4,000 for 2 months when we've got 18 months to sell, or at the time we had 20 months to sell. So imagine if we collect every 2 months, we collect that money. So 10 times in the next year, we collect $4,000. We'll collect $40,000 against our $7,000 outlay. Now, sometimes we'll win on the short calls and puts. Sometimes we'll lose on the short calls and puts. But we got $40,000. We have to lose a lot in order not to have $40,000 anymore. Even if we lose $20,000 of it, we still collect $20,000 against a long $7,000 position. And that's all this is. It's just math. You know, we talk about being the house. That's all we're doing. We're selling. This is selling. We're selling the risk. These two positions here are risks that we sold. Whoops. There we go. These two positions here are the risks we sold. Somebody bet us. This guy bet us that that GIS is going to be over 60 in June. This guy bet us that it's going to be under 60 in June. We took both of their money. It's $42.50, so $4.25. And that means that if it's under 64.25, we make money. And if it's over 55.75, we make money. Anywhere in between that, we make some money. And the nut that we have to cover is $7,000 basically. So once we collect $7,000, everything else there is profit. That's a proper butterfly position. That's how they usually start out. But what happens is if it goes way up or way down, then we start making adjustments on the trade depending on what we think it's going to do next. But if it stays in its lane, we just keep selling puts and calls, and it works out beautifully too. And this portfolio is so dull. It's that we touch it once a month and barely touch it then. And it just chugs along. It's such a wonderful way to make money if you like being bored. Gold is an artificial buy, right? Why didn't we sell short calls on gold? That was stupid. Wow. We really blew an opportunity here. All right, that's my bad. I mean, we're well in the money. So I was too complacent with the position, though. We really should have sold some calls. We missed an opportunity to make some money on that. Now I don't want to sell calls because now it's back low. But when it was at $13.50, I would have sold calls. Let's see. Microsoft is the same thing. This is a proper butterfly. We own the $42.50 puts. We own $62.50 calls. So we have a $10. So the most we can lose is $10, right? We sold the 55 puts and calls. And again, here we spent $13,400, right? And look what we sold. In March, we sold June, so 3 months. We sold $10,000 of puts and calls against a $13,000 position. That's how fast we could. So in the first quarter of selling, out of 6 quarters, we already recouped all our money. All right, and this one happens to be, again, it's within $250, and we sold $5 worth of puts and calls, and it's within $250. So we'll make half of that money. You know, we don't expect to make all the money, but we make, look, you can see it right there. $36.50, $17.50 profit. That's $5,300 profit minus 25. So whatever that, so basically 20. So we have $2,500 profit already in 3 months. So if every 3 months we make $2,500, that's fine. It doesn't have to hit the target on the nose. And because stocks go up and down, we don't freak out when they go up. We don't freak out when they go down because they tend to even out over time. Unless your premise is wrong, unless you see the company's deteriorating, their business model is screwed up, something bad happens, something happens, like if it's a coal industry, like last year we had BTU, fortunately we cut and run before it killed us. But BTU was dying. There was no saving it. So we finally gave up. At first we adjusted and lowered, but it didn't work out. And we said, screw this. The coal is, in fact, I started saying in the middle of last year, I was saying to people, coal is dead. Forget coal. It's a dead industry. So we got out of our BTU position. So that used to be in the butterfly portfolio. Because before this catastrophe, BTU, sure. Before this catastrophe hit the coal sector, what? Are they gone? I missed the memo. They go bankrupt. Does anybody know? I don't remember them going bankrupt. BTUQ, they did. Oh, wow. Wow, I did not realize they went into, well, this thing doesn't show it. But I didn't realize they went into bankruptcy already. What a shame. It was such a great company. Once upon a time, that was one of the best stocks you could own. BTUUQ. I think stock charts just might not have it, but we'll give it one more try. Nope. Wait, that's BTUQU. Oh, there it is. Oh my God. Look at that. So we started playing like last year when they were down here. We were like, oh great, they're settling down over here and we'll play them. But they were like crazy, and then they started going down, and we cut and ran around there when it was like back down below 10. We had a pretty good loss, but we were like, screw it, it's not coming back. We finally decided it's not going to come back. And when, lo and behold, it never came back. It's dead. Back to go to the portfolio. So, PG is another, January 218. Yeah, that's another normal one. We have the long puts, we have the long calls, and we sold the 80. Now here we spread them a little bit. We sold the $80 puts, and we sold the 82.50 calls. And you know what? That was a good idea because it turns out we're right dead center. So you can't do better than that. And we're just waiting for that one to move. Target is a normal one also, another normal. A lot of these are normal now. It's funny. We fixed a lot of them as the markets calmed down. We fixed a lot of them like a few months ago. For a while, we were like super aggressively bullish, and now we've sort of filled out all our positions to make them more even. So Target is a pretty new one. We added that in April. And here we've got the 87.50 calls, the 67.50 puts. We sold the 77.50 puts. Obviously, in those ones we were talking about earlier, they're a bit out of the money. The 82.50 calls are dead. Why didn't we adjust this? This needs to be adjusted. We should obviously buy back these calls. I swear, I'm sorry, I really thought I did this at some point. We need to buy back the 82.50 calls because what's the point? They're paying. They're useless. We need to sell something more realistic, and we can use that money to roll these down a little bit to put them in a position where they have more premium. So let's see. So obviously these are non-consideration. Look at the 77.50 puts, July, for Target. So I apologize before because we do want to do something with it because it's a shame if it's just sitting there. So we have the July 77.50 puts. They're $9, let's say. And what can we do? So what do we think Target's going to do between now and July? Not a lot, but let's say that's the problem. See, we don't really want to sell the 70. I don't want to sell the 67. I don't want to sell the 70 call. I really think they'll be back over 70. And that's not paying me enough to take that risk. Okay. So what I would probably do, and again, now I know why we're waiting though, because I must have looked at this before and it doesn't make sense. Depending on where they are when we get to July, if they were where they are now though, here's what I would do. I would sell the $70 calls for $260. I would also sell the 75 puts for $8. So what would we be doing there? We'd be selling for 8 plus 260 is like $10.50. We'd be selling $10.50, but notice that we have a $5 spread. So no matter what happens, no matter what number we're at, we're going to have to pay back at least $5. Even if they hit dead center at 72.50, we'd owe each of these guys $2.50. So we're selling $10.50 in premium, but we're giving up 5 of it. So what we're really selling in premium is $5.50 in the end. We're selling $5.50. Of course, we're going to roll that too, But the bottom line is, for sure, we know we're selling $5.50 in premium, no matter what happens. And also, because we're doing that, though, we have a nice wide gap. So since we sold the 70 calls, it could be all the way up at it could be $5. I'm sorry, it could be $5 over the 75 puts. So it could be up at $80.50. We're still good because we have the 70 calls here. We don't lose till 70. We don't lose extra. We go all the way down to 64.50 before we lose money there. So we can make ourselves a huge wide spread, and anything between 64.50 and 80.50 would be profit, or not profit, but catching up on where we are now. And that's what we want to do. We're behind. We want to catch up. Texas Instrument. This one is, no, this is not a proper one. So here we have, this is an artificial buy rate. So here we have the 55-65 bull call spread, the short 50 puts. They're in the money quite a bit. And here we have the short 55 calls, which we're in trouble on, and we'll have to roll them. All right, and you see this position's about net neutral. We haven't got a profit here. We'll have to just roll these guys along to a higher strike, and we'll see what happens. If we have to, though, I'm happy doubling down on the position. And especially, by the way, because if you notice, the 55-65 spread originally was $4, right about $4. So, and it hasn't changed much. According to this thing, it still went out $5. If we double down on this, our average would be $4.50 on the $10 spread. I don't mind having the $4.50 for a $10 spread. So if we double down, then we'd only be half covered. So if it goes higher, we would do that, and then we'd probably roll these to a higher strike. UNG, we know about that one. We're just aggressively long on this one, and unfortunately it's not moving yet. We'll see what happens. Valero, this is kind of a kooky one. Let's see. Here we have, again, the artificial buy rate. We've got the, only in January, we have a 55-70 spread, and it's at 55, so we're not in good shape on that spread yet. We sold the $60 puts of June. We're below that right now. We sold 65 calls. Those are worthless. So we're going to have to make some adjustments to that one, too, the same as Target. And then Walmart we already talked about. So as you can see, some of them are working out, some of them are not working out. But because we're relentlessly selling premium, we still make money, which is exactly how a casino works, right? He's got, a casino owner has 1,000 tables right on the floor. They literally have 1,000 different places where people are gambling because they know that the more people who gamble individual games, whether each individual person wins or loses doesn't matter. What matters is statistically, over time, they will collect a certain amount of premium on all the bets. And that's all we're doing. We're applying the same logic to stocks, okay? We take a lot of bets. We diversify our positions. We don't get too aggressive one way or the other. We don't get unless the market's clearly bottom like we did a while ago, then we got aggressively long. But we generally don't like to get aggressively long or aggressively short. We're just playing for the middle, and we're just taking all the bets. And in fact, it's interesting because unlike a casino, we can stop taking bets. Casinos can't really stop taking bets. They kind of have to keep the doors open. They do put limits on it, though. They don't want some gambler to be able to break the house. And but in our case, it's all at our discretion. If we don't like a game, we shut it down. Casinos can't do that. So we actually have a better advantage than a casino because we have better control of the game. So if we don't like the way a game is working, like I said with BTU, then we don't play it. That's all. We stop playing the game. We give everybody their money back and say, this game is closed. If the casinos did that, they'd be in trouble. If we do that, nobody cares. We get sell options again tomorrow. Oh, the beige book is coming out. I forgot about that. All right, let's see if we got any questions. Silver we talked about. What are the odds they come away with some sort of agreement with OPEC tomorrow? I say the odds are 10%. No, 15%. I say a 15%, 1 in 6 chances they'll have an agreement. Not very good. They can't have an agreement. I mean, the Iraqi guys and the Iranians and the Iraqis hate each other. The Iraqis don't like the Saudis. The Saudis don't like the Iranians or the Iraqis. Russia's not even there. How are you going to have an agreement? What are they going to agree to? All they'll agree to do is to discuss it at another meeting. I mean, that'll be their best thing. May 26th, we adjusted target. Okay, so it just hasn't been reflected there. Thank you. I knew it did something about it. Beige book, 15% seems high after 1,000 years of fighting. Yeah, that's what they say. I'm being well, I'm saying 15% because they got to do something. They're crazy. The strategy, there's no strategy. The strategy of having no strategy is nuts. Ooh, okay, we're still hanging out at 16.8 on the Nikkei. We're waiting for the beige book. And what's the beige book going to tell us? We'll find out. Oh, wait, it's out already. Hang on. Fed. Oh, wait. Here's a summary. Let's listen to the TV guys. Modest growth in 6 districts. Oh, that was useless. Tight labor markets are pushing up wages. That's key. Chicago and Kansas City say growth is slowing. 6 districts have modest growth. I think it's a repeating loop now. San Francisco sees moderate growth. I don't like that. See, I hear this. See, to me, if you say San Francisco sees moderate growth, if they're not growing, that's where Silicon Valley is. If they're not growing, who the hell is growing? You can't even buy a freaking 1 bedroom in San Francisco for less than $1 million anymore. All right. So let's go over this fairly quickly. Okay, economic activity through May increased moderate pace in San Francisco. Modest growth reported Philadelphia, Cleveland, Atlanta, Chicago, Minneapolis. Chicago noted it slowed. Okay, so, again, like I always do, I score things when I'm reading it. So basically, economic activity through increased moderately in San Francisco. What is the difference between moderate and modest? I mean, isn't that is so asinine? But let's say that I'm going to assume that moderate means okay, modest means not very good, means anemic. In Fed speak, you have to think about how they try to put spin on things, right? So they're saying modest. Modest has to mean anemic, and I think the reason they're saying modest is because they're worried it's going to tip into a decline. So modest, modest is, modest. Modest is a girl covering her, holding her hands over her chest because she thinks her top is too revealing. So that's not very much at all. Philadelphia, Cleveland, Chicago. Okay, so then you put Chicago there, but then immediately they say Chicago noted it slowed. So the modest growth, which is less than moderate growth, has slowed. Kansas City has also said that also. Dallas said it grew marginally. Marginally is even worse than modest. So we're learning the Fed scale here. There's marginal, modest, and modest. So marginally I'd say is not at all. New York characterized as flat. Now flat is flat. So these are our degrees. We have flat, marginal, modest, moderate. None of these sound exciting, right? So New York gets a triple word bonus, like if you're playing Scrabble. New York is a triple bonus because it's much bigger than any other district, and they say flat. Chicago is our second biggest district, and they say slowing. Kansas City, slowing. Philadelphia, that leaves you with clean, modest growth in Minneapolis, St. Louis, Atlanta, Cleveland, and Philadelphia. So half the districts have okay growth, the rest slowing, flat, blah, blah, blah. That's not good. Several districts noted contacts had generally optimistic outlooks, with firms expecting growth to continue at the current pace or to increase. Well, it's better. Consumer spending was up modestly on balance in many districts. Modestly on balance. Wow, that's another modifier. Though contacts in Boston, Cleveland, Minneapolis, oh God. Okay, so many districts is not most, is it? I mean, if you have 12 districts, this really pisses me off with these guys. You have 12 districts. What's many out of 12? 8 would be the most, right? That's the most you could hope for to say many is 8. Otherwise, you'd say most. So many is at most 8, probably, 6 or 7, and maybe even 5. 4, that would be stretching it to call many 4. Contacts, but then they're already telling you that Boston, Cleveland, Minneapolis, and Dallas says 4, say it's mixed or flat. New York says weak. So now 5 say no, not modest, bad. Many districts reported modest growth in non-financial. Manufacturing was mixed across districts. Construction and real estate expanded since the last report. Overall outlook among contacts in these industries remained positive. Overall loan demand was up moderately in all but one of the districts. That's okay. And many districts reported steady to good credit. That's good. Crop conditions were promising in many districts. The low commodity prices put pressure on agricultural income. Energy sector remained weak. Employment grew modestly. Tight labor markets were noted. Wages grew modestly. Price pressure grew slightly in most districts. That's okay, actually. We don't mind that. The Fed doesn't like it. The Fed doesn't like any sign of a rise in labor costs. When they say they're there to control inflation, they mean wage inflation. That's what they're there to control. Consumer spending in tourism was up modestly in many districts. Boston, Cleveland, Minneapolis, Dallas reported mixed or flat. Retail sales. Only New York reported weakened sales in April and early May. Only New York. And I saw this when I was in New York. I was saying a while ago. Last time I was in the city, I was actually very disappointed at the retail signs. Boston, New York, Philadelphia indicated cool spring weather dampened sales. Wait. So New York reported weakened sales, but Boston, New York, Philadelphia indicated dampened sales. So dampened is better than weakened or worse than weakened? And they said New York twice. So that's weird. Retailers across many districts reported increased competition from online sales, citing a shifting consumer preferences away from in-store shopping. That's an excuse to me. Luxury and premium products. And it is an excuse because you see some retailers doing well and some are doing poorly. Luxury and premium product sales are notably subdued in Richmond, Kansas City, and San Francisco. Now, San Francisco was our shining star, right? They were the ones that said up here that economic activity increased at a moderate pace, but not luxury and premium products, apparently. Since the last report, tourism and hospitality sectors saw activity. So the plus I would have given San Francisco over there is now kind of drifting down a little bit because I'm like, hey, I don't know if I can give them a plus if they're saying that their luxury and premium products are doing poorly. Tourism and hospitality sectors saw mixed activities in New York and Minneapolis. Philadelphia, Kansas City experienced improved activity. That's interesting. Contacts in Atlanta, Richmond, and St. Louis indicated hotel and hospitality bookings were higher than a year ago. Among districts reporting new and used auto sales were steady in April and May, with the exception of Philadelphia. Steady except for these three places where a slight decline was reported. You don't want to see any. See, if the market was low, if we were like at 1850 on the S&P, I would read this and say, oh, that's not so bad, okay? But it's not. The market is at an all-time high, and you're telling me that we have three major Fed districts that are seeing declining auto sales. That does not jive with all-time high markets. Dealers in Chicago reported a rise in new and light vehicle sales. Overall, truck and large vehicle sales output. Oh, there was a guy today, he got a good explanation for this truck and large vehicle thing. And I agree with this concept because, school shooting at UCLA. Damn it. the thing about the SUVs now is the SUVs get like 30 miles a gallon. So a lot of people are buying SUVs now because they're like, well, screw that. You know, when they got 15, 20 miles a gallon, they weren't very attractive. They're certainly better. I could never go back to having a regular tiny car after getting used to like having places for all my stuff and tons of room. And it's like you never think about space. It's not a concern in your life, the space of your car. And also, you don't feel like a truck's going to kill you every time you drive by one. You know, so it's hard to go back from having an SUV to going to a small car. And I'm sure a lot of people have small cars would love to have SUVs, but you know, when you look at the 15 miles a gallon, 17 miles a gallon versus 25, 30, that was different. But now, you know, yeah, a little car gets 40 miles a gallon, but the SUV gets 27. It's just not that horrible anymore. And it's not enough to dissuade people from buying the SUVs. So a lot of sales are drifting towards the SUVs now, which you want to make as well because they make more money selling SUVs. So I guess it technically is working out for everybody, but it would be nice if we saved a bit more gas. In Cleveland, 1%. Dealers in Richmond reported light truck sales. Luxury vehicles were mixed. Cleveland weakened demand. Chicago shift upward in demand. Philadelphia, blah, blah, blah. Optimistic, blah, blah, blah. Okay. And okay, by the way, due to low gas prices, what happens when the low gas prices disappear? This whole thing can crumble. When when things are due to low gas prices, then you have to start making considerations about what happens when the low gas prices aren't there anymore. It's even worse if people start turning in their SUVs too. All right. Since previous posts, many districts, including New York, Richmond, St. Louis, and modest growth across non-financials, where San Francisco growth is moderate, Philadelphia, no significant changes, New York, steady rise, Minneapolis, Kansas City, Dallas, reporting expansion, technology, professional services, Dallas, expansion in the healthcare sector, Boston, contact staffing, characterized activity is strong. Oh, that's the first time they said strong. Boston staffing is strong. Dallas Cleveland transportation services declined. Uh-oh. That's sad. Bad Cleveland. Railroad activity down by as much as 35%. What? That's horrible. All right, so railroad activity down by 35%. That's terrible. Kansas City decline in transportation activity, capital spending. This is not all-time high S&P kind of numbers, right? Activity. Richmond, transportation, trucking, airport activity, uneven and flat. It's pretty wacky. Contacts in Richmond, St. Louis reported optimism in the coming months. You get a lot of that. You get a lot of people who are like, it's funny, it's like, current conditions stink, but we're optimistic about the future. That's why a lot of people think that the economy is going to turn up in the last half of the year, because it's kind of like that's what everyone's saying. That's what the economist is saying. But so far, I'm not really seeing the signs. And especially if anything goes wrong in Europe or Japan or China, we've got big problems. That's why I'm very worried about the summer. We get through the summer, I'll be a lot happier. Manufacturing mixed. Increase, Atlanta strong. Minneapolis slightly. Activity flat in San Francisco. Fell in New York, Philadelphia. Oh, no, fell in New York, Philadelphia, St. Louis, and Kansas City? Ow! Well, we know that from the ISM report anyway. Outlets manufacturing improved since the last report in Philadelphia, Cleveland, Atlanta, Kansas City. Outlets in Boston, St. Louis, positive. District reports growth mixed across manufacturing. Cleveland, all right, increased demand for construction materials. Dallas reported, Dallas has the oil problem, so that's fine. We know that's an exception. Metal manufacturers, new orders have risen. Chicago reported growth in steel demand. That's a good sign. Producers in England were encouraged by, in Cleveland, were encouraged by domestic steel prices. Little change. San Francisco steel producers from reduced overseas competition. Contracts for some weak demand in manufactured metals. Philly, Dallas, weakness in primary metals. Boston, blah, blah, blah. All those guys reported weakness tied to demand from the energy sector. So you see the spillover effect. This is an interesting thing. If you kind of get a view of the country, you can see the spillover effect of the energy sector. You have Boston, Philadelphia, Cleveland, Chicago, and Dallas are all getting hit by the energy sector. There's the sound of the Nikkei filling my thing. So apparently the Nikkei must have popped up again. Oops, wrong one. Active trader. Yeah, there we go. So we got the little pop to 16,825, and now, well, see that 25? So now my break even is right about here. It's actually 225. I know that. It's 16,825. So now I've got one again, and I'm right where I want to be. And now we'll see what happens. So what changed? Well, the index has popped up. The dollar is still laying there. That's not good for the Nikkei. I need that dollar to get moving. But the indexes are making new highs, not new highs, but new highs compared to where they were when I started this thing. So I'm okay about hanging on to this for now. We'll see what happens. All right? So remember, we're hoping that we get up to about 950. But that would take, it would take a dollar move back up here. It's just not happening right now. And so let's take a look at the bigger picture on the charts. So yeah, that's encouraging. Look at the S&P now. We're going to watch it when it gets to 2100 if it makes it. We want to see the NASDAQ break over there. We want to see, wow, the Russell is, see the Russell, as long as the Russell's over 60, we're good. We're going to be in good shape there. Anybody who's doing this? Is Apple? No Apple. No, Apple hasn't even moved yet. Apple can still really boost the markets by coming up. So who's having a good day? Look at Twitter coming off the lows from the other day, huh? Very nice. XLF, TLT, natural gas still coming along strong. Oil made a nice recovery here. No, I don't see any particular thing. I don't know if anybody said something, but no particular. I guess the beige book. I guess people are interpreting the beige book as being not bad. And it's not bad. It's just not great. Where were we? Construction and real estate decline, single-family construction, residential construction, commercial real estate activity reported in most districts. Absorption of space increased in Atlanta and Kansas. That's good. Dallas reported healthy demand for office space. See, I'm going to see. I guarantee in New York they have some. They have decline in vacancy rates in Chicago, Minneapolis, San Francisco. Demand for commercial real estate expanded further, particularly in urban areas. Residential real estate was strong in most districts. Boston, Cleveland, Kansas City, San Francisco. Oh, no mention. Here you go. Lower inventories of homes in New York. No mention of commercial in New York. That's interesting. Because, I mean, from my observation, commercial in New York was not good. I think the problem in New York and maybe some other cities, but San Francisco doesn't see it. I think there's less commercial space available in San Francisco, though. If you think about it, it's got, if you've been to San Francisco, it doesn't have like the kind of commercial zones that New York does. New York has so many empty spaces. It's really shocking. It's like, but they price themselves out of the market. Who can afford the kind of money they're asking for these spaces? $1,000 a foot, things like that. So who the hell can pay for that? Banking and finance, loan demand moderately, exceptions, commercial loans are up in these places. Atlanta says strong loan demand, except for the energy industry, of course. In Chicago, business loan demand changed little. Mortgage lending was up, but that just was down again. Dallas reported overall lending was mixed. Philadelphia. Agriculture and crops don't care. Employment wages. Employment grew modestly since last report. Tight labor markets. Widely noted in most districts. Demand for labor rose in Richmond. They've said about Boston staffing. Atlanta, Richmond workers are in high demand. Wages grew modestly since last report. Increased concentrated area of labor. Higher wages reported in entry-level, low-skilled in Richmond, Atlanta. San Francisco, minimum wage increases pushed up wages for skilled workers, diminishing effects of the pay scale. Atlanta, St. Louis, San Francisco reported wage pressures in certain high school employees. In New York, sizable share of service sector reports reported higher wages. In St. Louis, 2/3 of the hiring managers increased wages by more than they have in the past several years to retain employees and attract new ones. However, Kansas City contacts in the industry report a slight increase in wages and similar increases going forward. Wage pressure is minimal in Dallas because everybody's unemployed from the oil, due in part to the energy services rate. Okay, price pressure slightly. Okay, so this is all good. Good wage pressure, not so much that it's alarming the Fed. That's a very good sign. Oh, that's it. Okay. So on the whole, yeah, it's an okay report, but it's not an S&P break over 2100 report, but it's not terrible. It's not like, burn the bridges and sell everything kind of report either. So on the whole, just a good report, let's call it, and the market is reacting appropriately to it. All right, there's still no reason to bust over 2100, but at least it's going to, for today, it's going to give us a reason not to go down. And the Nikkei is creeping up, and see, I don't know why the dollar. See, it's funny because it seems like if it was really good, you'd think the dollar would move up because better economies, more demand for dollars. Okay, John says, I've not yet established which butterfly positions would you recommend to start with. Well, just take a look. Take a look at them and think about what you want to look at here is the net cost. So obviously, this has gotten away because there's a huge profit, right? This one hasn't moved at all. Just look at the net profits on the positions. If they haven't moved that far, you can still play them, and you have to calculate. Say, how much am I going to spend for my long position? How much am I collecting on the short position? And then what going forward? How many units of short positions will I be able to sell? So this one's okay. PG's okay. It's still sort of middling as far as profitability goes. TXN is okay. Still middling as far as profitability goes. Valero's out of the way. Walmart's too complicated. I wouldn't do that. But again, by the way, and we talked about this, go back to chat, okay? Because in member chat yesterday, we had a whole discussion about this. When we begin the butterfly portfolio, we take one position, two positions, and we work them for a couple of months. And then when they're on track and they've made good money, then we take another position. We don't jump into like 5 positions at once. It took us 2 years to have a dozen positions in the butterfly portfolio. Because it's meant to be played very conservatively. And you don't know, every time you take a new position, you don't know if you're going to make that first round of money. If you don't make the first round of money, you're going to have to adjust it. And if you have to adjust it, then you shouldn't have another position to distract you. As each position gets on track and you book some money and you have a buffer, then you can afford to start another position. So it should be a long, slow process where you very rarely, very occasionally add positions. And you work them and you pay attention, and as you learn, as you go one by one and add positions every couple of months, you'll learn how to handle them better and it'll become more natural for you. But you have to think about it as a process. You can't just jam in a bunch of positions. So John says it's generally so like I said, it's not a late start. Every time we sell short-term puts and calls, every time the puts and calls roll over, we're taking a strike that we like. Then it's just a question of you have to look back at the long position and say, is this long position still reasonable given how much money we're collecting up front? It changes because if the VIX is high, we make more money selling puts and calls. If the VIX is low, we make less money selling puts and calls. That drastically changes the math. Drastically changes the math on whether or not you're going to have a good or bad butterfly position. We try to buy the long calls when the VIX is low, and we try to sell when the VIX is high, if we can. So and by the way, we always sell on the rollover dates, on the contract rollover dates, but we'll sell more aggressively when we're getting a good VIX. When we're getting a lot of premium, we'll sell more aggressively. And when we're not, we don't sell aggressively. We've taken time off. We've said, okay, we're not. We've gone a couple of months and said we're not selling any calls because we just didn't like the volatility. We thought the market was too low. Whatever. So that's what you got to pay attention to is when we do our rollovers, which is usually like the week before expirations or the week of expirations. That's when we do our rollovers. That's the best time to see what positions are still good. Any guesses on how natural gas? No, come on. Natural gas and oil, you have the OPEC meeting. Could be anything. All right, 225. Ugh. Wait, what do we all right, well, the short-term portfolio is going to be an easy review. The long-term portfolio is going to be a bitch, though. Short-term portfolio, my baby. Oh! Under 400%. Damn it. 399.3%. Not bad, but I want that extra point. Actually, considering the market is up, it's actually holding up incredibly well. Considering that we have these heavy short bets. So we've got our SDS calls. These are basically dead, of course, but it's, I mean, they're out of the money enough where unless we have a serious crash in the next couple of weeks, these are dead. FAST is a short calls on the FAST that we have. SDS is a spread, a hedge for September. TZA is a hedge for, these are both call spreads, of course. Oh, it says that right there. TZA is for July, and XON is a bullish play, and that's for July, and that's in the money still. Amazon is the bear put spread, and that's, well, it's in the money. We paid, what? Oh, it's a $100 spread. Silly me. Okay. It's a $100 spread. We paid less than $50 for it, so like $45, $46. So basically, our break even is $700, and we're not there yet. And we're about $1,000 behind. So I'm not happy with the way it's going. October, I still think the time frame is okay though. But Amazon just goes up and up. I mean, it's unbelievable. That's why we only have two. Look at that thing. So 700 didn't stop it. That means we might see 750. But when we get 750, I'm going to be happy to add some. We'll do a roll and add some more. Oh. Here's the rest of the fast play. Now, generally, we have a lot of bullish positions. We have 40 longs, and we only have 30 shorts. But we also have these 60 longs. That's why we wanted to be aggressive, because we have these 60 long 35s, too. So I wouldn't mind, actually, if it went up, and we could easily roll these. Leibu is the biotech thing. That's doing well again. It was doing badly for a while, but it's doing better. This is silver, SLW, and again, we should have covered with some short calls. We didn't. And here's SQ2. This is our new one where we have the 1723 spread for September. So plenty of time. We have the short June 21s, and those are obviously way out of the money. They'll expire worthless. So, I mean, amazingly, the short, frankly, I don't even know how this mixes. This is a very bearish mix of stocks. I don't understand why it's still up at 400, frankly. But we're not going to complain. Long-term portfolio, there's no way we have time to review this. I do have to wrap this thing up at 2:30, which is now, I think. Yep. I will get to review this week of the long-term portfolio, though, so I'll put it up. Here's all our short puts, which we're generally happy with. In fact, you can see most of them are green. Who's not green? Let's look at that. STX, not green, but I don't mind that target. Look at our net. Our net's $20. They're above 20. I don't mind that, then. CMI is a new one. I like them. CCJ, yeah, I'm kind of fed up with them. I thought we killed them. Bid, they just never get moving. It's sad. Sotheby's I love, so I don't care that they're behind. And anyway, here, see, we sold 35 puts for 740. That's 28 and minus 40 is 2760. So our break even is 2760. They're at 30. So not at all worried. And that's it. Oh no, and AA we're losing money. But the net sell on AA is also ridiculously low. It's 775 and we're at 919. So we're not really losing money. It just says we're losing money, but it's a great sale. Bull call debit spread. Seadrill, Jesus, do they still exist? They're actually doing much better. We have a 50-cent calls. So we never bought these back just because it's not. I mean, who wants to? I'm not going to pay 60 cents for the $10 calls. That's ridiculous. So it's just kind of stuck in the spread, but the spread's fine. So basically, we own Seadrill at 50. It's at $3. So this is actually working out to be a nice position at this point. These are our dividend plays. These are all the stocks we collect dividends on. Those are all fine. I mean, you see here barely any losses, right? And you can't have all winners because we purposely, like, we sold the short calls. We're betting against ourselves. In fact, these are weird. We're winning on all three, and again, it's because we sell premium, so you can win on all three, because even though logically, how could you win on all three? When I sell $14 calls and $14 puts, you would think you wouldn't make money. You can't make money on both because they both say 14. One of them's got to be wrong. Oh, wait, June. No, they didn't expire yet, did they? June. What month are we in? No, June didn't expire yet. And here we have custom spreads. So we have Apple, ABX. Let's just read if we like. We love it. We love Apple. We love ABX. We like DHI. We like CMG. Chipotle, Coach. Got no problem with Coach. Even though luxury sales, keep hearing bad things about luxury sales. We've got to keep an eye on those guys. Well in the money, though. Disney, we love. Expedia, well in the money. I'm not too worried about it. FCX, we love long term. Look how FCX is 200% in the money. GNW, I like them for recovery play. IBM, we love. They were a run out for stock of the year. iRobot, we wanted to get out of them, but they just keep doing well, so we never do. It's like, why should we not wait and take the full amount? Lumber Liquidators, we like long term. North Star is another dividend payer. I don't know why they don't go with the other guys. Why don't they? Because it's uneven. That's why. The reason they're in a custom spread is because these guys, we all sold the right amount of puts and calls. For North Star, for whatever reason, we sold 15 puts and only 10 calls. So because we have the extra puts, it doesn't go in the right place. It puts it down as a custom spread instead of a regular covered combination. OIH, eventually we think that'll recover. RIG, eventually we think that'll recover. Silver Wheaton, same thing. We like them. We have them really cheap. Phaser, that's one we like, and I'm not worried about that one. Twitter, we like for a long-term recovery. UNG is natural gas. We like them. Walmart, we think will recover eventually. And Yahoo. Yahoo's in the money. It's 100% in the money for it. So again, all good positions. They're up 95%. You can't argue with being up 95% in your long-term positions, because this is where you put the bulk of your money. Long-term positions are where you should have most of your money. And the things that make money over time, long positions, these are the trees that we plant that we expect to have in our portfolio for for the next 20 or 40 years. So they're low touch, low thing. Most of these things we don't sell short calls against them. We touch the long-term portfolio less than we touch the butterfly portfolio. And yet, in, November, 214, 215. So in 18 months, basically, this thing's up 100%. Not 18 months. In 30 months. In 30 months, it's up 100%. So it's averaging like 3% a month. And that's great. We're not trying to make a lot of money. We don't want to be aggressive in this portfolio. This is where our big money is. This is where the bulk of our retirement savings goes. We just want good positions, long-term, cheap, that we either eventually can sell options against or collect dividends on. Oh, what's with ARR? We should have sold puts and calls against these guys, right? I got to look at that, because at some point we should have sold the puts and calls. Where are they? I certainly want to sell the puts. I'm not sure I want to sell the calls this cheaply, but I do want to sell puts. So as we go through, we'll make some notes. All right, and that's to wrap this thing up, guys. Let's see. Beige Book, subdued, and you guess it's somehow natural gas, LTP, FCX worth to play here. I like FCX. So they still, how cheap are they still? That didn't work. Yeah, they're still a good price. I mean, I look, because I don't like them at 10. It's not cheap, but oh, how's that thing? Forgot all about the Nikkei. Ow! Missed my opportunity to take a profit. Oh well. So now we're back at 16,810. The dollar's holding up though, and the indexes are still strong. I'm going to stick with it, but I'd like to get at least 850 out of it before it goes. What do we say here? What were we going to look at? FCX, right? FCX. So I don't want it for 1058, but what you can do though is I promise to buy it for 6, right? You see, this is I mean, I don't know how I cannot strongly enough tell you how this is the way you should buy all your stocks, okay? It's like, yeah, I like it. I like FCX. The 1050 isn't the lows. It's nowhere near the lows. But you know what? Even though they're at 1050, I can sell the $8 puts for $2. That's net 6. That's almost half price. It's like 40% off the current price. So my worst case is net 6. Even if they drop to 8, even if the stock falls 20%, it'll still be over 8, and I still make $2. Now, I'm only promising to buy it for net 6, so $2 is 33% in 33 months. So in not 33 months, sorry, in 18 months. So in 18 months, I get 33% back on my net $6 commitment. I keep the $2 if it goes well. The worst thing that can happen to me, though, is I own FCX for $2. So there, you're done. That's your plan. That's why we have, in the long-term portfolio, 25 short puts. That's how we play them. If the short put gets assigned to us, then we turn it into a position if we still like it. So in FCX, where's my short puts? You see here how we sold, in fact, we sold two sets. We sold the $4 puts and we sold the $5 puts at one point on FCX, right? So 2 different times with FCX we sold the puts. On 122 and 226. And I guarantee you, if you look at the chart, I don't have to look. On 122, it was cheap, and then I think it got cheaper. So let's see what happened to us on FCX. Yeah, wait. Oh, here you go. Oh, no, here. Oh, I see it. So we took around here. So on 122, we sold the puts, and then here we have another dip, and we sold some more. And fortunately we did, because then it started taking off and getting away from us. So, you know, I guess we didn't have as many as we wanted at the time. I don't remember the exact circumstances. Where am I? Anyway. Oh, yeah, we're going to go back to the... But you see, at that time, we took a really... And even then, though, when FCX was at 350, when we did our first position... Oh, I remember that. I was at the Money Show. That's why I made a new trade at the time. That's why we took the second position, because I still liked it a lot. And I was doing that Money Show in February. But on 122, so it was at 350. We sold the $4 puts for 220. And my logic at the time was like, that's net 28. That's net 180. It was, at the time, it was half of where it was. And you can do that again. But we weren't greedy, because look, all we did here was we took the $1 calls and the $5.50 puts as a spread with that. But the second time, we didn't even add to our spread. We just kept it the way it was. If it gets cheap, then we'll buy the stock, but we don't need to buy the stock if it doesn't get cheap. And really, there's nothing you can do with a net $6 position that's going to improve it. But you could say, well, I feel like that's going to be free money, so I could spend some of it. So you could take half of that money, maybe. So you're going to be you'll be net 7 instead of net 6. And if you take half of the money you collect on this side and you put it towards a spread, like an in-the-money spread, though, so here's 350, and here's 650-ish. Yeah, here's 640. See, so basically for $3, you can get the 5.10 spread. So if you did the $3 5.10 spread, and you applied $1 from the other side to it, then your $2 in a $5 spread, and that means anything about, and so now both your break-evens are 7, right? Because you have $2 for the $5 spread, and you have the $1 left on the $8 puts. So 7 is your magic number, and 10 is your goal. And now at 10, instead of making $2 that you would make on just the puts, you're going to make $1 on the put side plus $3 on the other side to make 4. So you're going to double the amount that you make at 10. But is it really worth it? I wouldn't. I mean, frankly, I wouldn't. It's not cheap enough that I get excited about that. When it was a 1-5 spread, I was super excited about it because I thought 5 was ridiculously cheap anyway. But now at 10, I'm like, no, it's still lower. Something could, the economy could turn down. It could drop 20%. And if they drop 40%, then I don't mind owning a ton of FCX for the rest of my life. And don't forget what FCX is. FCX is here. Here's the company profile. FCX is 58% copper, 23% oil and gas, 15% gold. That's where their money comes from. Mostly copper. And what copper? South America, North America, Indonesia, Africa. Not China. I like that. Although Africa is now China, basically. It's been taken over. But North America, South America. Okay, so that's good. The oil and gas is oil and gas. Doesn't break it down. The gold is not broken down either. So that's what you want to look at, though. Oh, and molybdenum. They will have that. They will have a little bit of that. But the copper mines is the key, and copper is an infrastructure thing, and I'm telling you, without infrastructure, at some point the global governments have got to start spending on infrastructure. There's no other way to really boost the economy. So at some point, I think that's going to happen. I can't believe they're going to just keep doing what they're doing because it's not working. It hasn't worked. It hasn't worked yet, and it's still continuing not to work. All right, so we're going to wrap this up. I'll see if there's any more questions, and then we got to get out of here. FCX was a good question. USD seems like it is leaking slowly. Yeah, I don't know what's up with that, frankly. No, here it comes. Okay, no, 95 is fine. Look, 95 is the midpoint of the current range. It should be creeping up towards 100 as we get closer and closer to the Brexit, and especially the more it seems like they might leave, the dollar's going to just be more and more of a safety play, and people are going to run to it. I can't see why we would be below 95 until people are fairly sure that the Brexit thing is off the table. So, and even here, though, I mean, it's not like we've been below 95 very much at all, right? That's the last year, and here's 95. So being below 95 is not normal. So the closer we get to Brexit, we should be starting to see closer to 100. We should start seeing this move. And see, last July, we kind of bottomed out last July, and then we creeped up to, 99. But I think with a Brexit catalyst, I think we could easily get to 100 again. Maybe, this high or whatever, even a little over 100 before coming back down. And then it depends on, but of course, if there is a Brexit, then you may never see 95 again. And even if you look at like the grand scheme of things, look, it's been since early 2015, that 95 line has been basically a good hold. There's just an unusual dip in the dollar here, but and you see a spike below. I think it's a blow-off because I think this is all a blow-off move trying to get people out of the dollar before it actually starts going up. Now, whether we break over 100 and hold it, I don't know. But again, if England leaves the euro, I think you're going to start seeing the euro gradually just start tearing itself apart, and bit by bit, it's going to be, look, the UK leaves, right? That puts more pressure on every other country. So now, let's say the UK was 10% of the euro, right? That's about right, probably more. They're probably more than 10% of the EU. Economically. Population-wise, they're 10%, but economically, I think they're more than 10%. So the burden shifts 10% more to Germany and the other countries to do bailouts and help the other countries and so on and so forth. That's going to piss them off. Now, then the other countries that leave, when they look at if England's better off or worse off, as soon as they see that England is actually better off out of the euro, they're going to start leaving too. Greece will be gone in a second. So, the only reason Greece has austerity is because they're in the euro. If they left the euro, they would just write a check and pay off all the debts with their bullshit currency. So I think that you'll see the sort of cascading effect, and people are going to start the European Union will start falling apart. And they really can't lose too many countries before the whole thing collapses. And also at the same time, all their currencies will be devaluing because everybody will be running for protection out of their currency. So that will be another catastrophe in the making. And that will then put more pressure on countries that need bailouts because Greece has to buy food from other countries, or Greece has to buy oil from other countries, and when they're buying the oil and and the euro is weakening, then oil prices go up compared to that, and so on and so forth, and it'll be an incredible mess. Incredible. And it'll hit really hard and fast. So that's what we have to look forward to. We'll find out in a month if it actually happens or not. There's no doubt. I mean, it's obviously why everybody's trying to tell the UK to stay in the euro. There's no doubt it'll completely screw up the EU. Whether it screws up England or not is another question. I think it'll be a great step on. I think it's a huge positive. But, should they altruistically not leave so they don't screw all their friends over? That's hard to say. Oh, and by the way, they are going to leave. It won't be like tomorrow they're out of the EU. It'll take them like 2 years to unwind themselves and extricate themselves from what they're in. They have to unwind deals and move this and that. And they have to make new trade deals and alliances and so on. It'll be a huge, giant mess. It'll have to be handled by a transition team. All sorts of things are going to have to happen. But it all starts in June. It all starts at the end of the month if it happens. Very interesting times. Yeah, and that's just Greece, right? Gold hit 2000. Who's next? I say, Greece would be next. So they really should leave. They should have left a long time ago. Portugal, Italy. I think Italy's going to make all sorts of demands to stay. They're a big enough economy where they matter, but they're also in debt enough where they need to do something about it before they end up looking like Greece. If the dollar goes to 100, what will our indexes do? Our indexes will pull back. It'll be one of the things that drive us back down, like about 10% or more. Maybe a lot more, though. Maybe people start panicking. That's why I want a lot of hedges. That's why I want a lot of cash. And what limit do we have for the Nikkei? It's 1 unit now, so I'm not really worried about it. But, look, if it's persistently below 16.8, and these guys are weakening, which they're weakening now a little bit, but if he's below 750, if he's below 95, if he's below 425, which he is, if he's below 1160, which he is, I'm going to start losing faith, and especially if the dollar doesn't get back over 95.50 and doesn't keep moving up, then there's no point. I was only looking at it to bounce. Oh, my meeting's here. I got to go. All right, guys. Thank you so much for coming, and we'll do it again next week. All right? Take care, everybody.